You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, listeners should know that options involve risk and are not suitable for all investors. Individuals should not enter into an options transaction until they have read and understood the disclosure document, characteristics and risks of standardized options, available by visiting the OCC.com or by contacting your broker, any exchange on which options are traded, or the Options Clearing Corporation at 125 South Franklin Street, number 1200, Chicago, Illinois, 60606. The Options Industry Council is an industry resource provided by the Options Clearing Corporation, collectively OCC. Any strategies discussed are strictly for illustrative and educational purposes only and are not to be construed as an endorsement or solicitation to buy or sell securities. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of several resources investors can utilize to learn more about options. Other resources OIC offers include webinars, articles, and self-guided options-related coursework. For more information, check out www.optionseducation.org. Now, here's your host, Mark Benzaquen.
Hello, everyone, and welcome to another episode of OIC's Wide World of Options. My name is Mark Benzaquen, and joining me once again in the studio today is my colleague, Mat Cashman, a 25-year options veteran with roles ranging from market maker to risk manager, among others, as well as a fellow options instructor here at OIC. So, Matt, welcome back.
Thank you, Mark. I'm very happy to be here to talk about options.
Matt, as you know, we're well into our summer of spreads here at OIC in terms of our webinar program. And our colleague Ken Keating sat down with me last month to talk about debit and credit spreads. And I understand that you're going to be taking the concept a bit further with your upcoming webinars in July by talking about condors and butterflies. So I thought it made sense to pick your brain today and discuss the nuances and special features of these quite versatile and unique strategies. How does that sound?
It sounds great. I'm happy to be a part of the summer of spreads.
All right, excellent. Matt, let's start with an overview. What are condors and butterflies, and why do traders turn to them?
Yeah, let's start at the beginning. So option condors and butterflies are essentially multi-leg option strategies that traders use generally when they have a specific expectation regarding price movement in the underlying asset. Now, that's a very generalized way to talk about it, but a butterfly spread involves buying and selling options at three different strike prices, usually within the same expiration month, sometimes aiming to profit from a stable underlying asset price until those options expire. Option condors, on the other hand, are similar structures, but they involve four strike prices generally. Two of those strike prices are usually designated as what we call the inner wings, and two of them are designated as what we would term the outer wings. The condor spread allows traders to capitalize on a specific range of prices within which they expect the underlying asset to remain up until expiration as well. So they're similar in some ways, but they have key differences between the two of them.
Okay, excellent. And the key to all of this, I guess, or the objective to an investor trading these multi-legged spreads would be the income premium they generate. Is that right? Kind of like the idea of why sell just one option when you can sell 3 or 4 and multiply potential profits?
Yeah, certainly. That's one facet of these spreads. It's important to understand, I think, the concept of what I term premium over parity here. And that terminology is really just a way to measure and then discuss how much options premium you are either short or long over and above the intrinsic value of the option. So if you've listened to any of our content on that subject, you know that when it comes to the value of an option, intrinsic value and extrinsic value have completely different decay functions when we're talking about time.
Okay, and since we might be selling more option premium than we're buying, that time decay is working in our favor, isn't it?
Yes, it is, in a general sense. And especially if your premium over parity number is negative, meaning you are theoretically short option premium overall, that comes from the extrinsic side of the options value. And building on what I said before, generally the extrinsic premium of an option decays faster than the intrinsic premium of the option, primarily because of the time component that is built into that valuation. As time comes out of an option, its value, generally speaking, erodes as measured by a Greek that we call theta.
Okay, and taking that a step further, what about implied volatility? So I'd expect that since we're talking about 4 legs for each strategy, implied volatility might have a tremendous impact on condors and butterflies, no?
It does, yes. And generally speaking, implied volatility plays a crucial role in options trading overall, including condors and butterflies specifically. Implied volatility represents the market's expectation of the underlying asset price movement going forward. And it's factored into option prices pretty heavily. Higher implied volatility, if you keep everything else constant, typically leads to higher option prices, as there's an increased likelihood or a perceived increased likelihood of larger price swings in the future. So when trading options, condors, and butterflies, it's essential to assess and manage implied volatility. Just like in any way, shape, or form when you're trading, it's important to manage your risk to implied volatility movements. But traders can use options Greeks such as delta, theta, and vega, which I just referenced, to understand how those changes in implied volatility can impact their positions, specifically positions like condors and butterflies. Now, monitoring and adjusting the spreads based on how implied volatilities are moving can help traders optimize their strategies. The important part here, because of these strategies, they are complex strategies, meaning that you're both buying and selling some options with both of these strategies, both butterflies and condors. And so the changes in implied volatility can become slightly more nuanced for these spreads, meaning some of these options can move more than others when you move implied volatilities around, which makes it even more vital to have a solid grasp on the concept of implied vol through the metrics like the Greeks provide, like delta, theta, and vega. It's really important to be able to keep your finger on the pulse of how those things are going to move when we're talking about these spreads.
Okay, excellent point. What about trade mechanics? How do traders enter a condor or butterfly position?
So there's a couple of different ways that people approach this and how they can potentially enter into these spreads. Some traders prefer to open these positions as one single trade, executing all the legs simultaneously. Now, the interesting part about that in the United States equity and index options market is those spreads are generally quoted as one price, and thus they're available to actually be executed as one price. This approach, trading it as one price, provides a predefined risk and potential reward right from the start. It's a little bit like having a turnkey house that you buy or sell. Like it's ready to move in, and you just move in and you have the entire position on with one click of a button. So that's one part of that is really a function that exists and is very robust within that marketplace. Now, other people choose to build these spreads gradually over time, and sometimes what we call leg by leg, where they leg into or out of these trades. And what that means is you are trading into or out of parts of the spread as the market conditions evolve over time. This allows you to adjust the position based on either changes in the underlying asset price, changes in the implied volatility, and people can have different views on where or when it's time to trade in or out of those spreads. Traders can roll in or out of their options by closing existing positions, opening new ones with different strike prices or different expiration dates. Additionally, implementing proper risk management techniques is crucial, especially when you are doing things like rolling in and out of positions. This includes determining appropriate position size, setting stop loss orders, and considering profit targets for all of these trades. Having a well-defined plan for potential adjustments or exits is really key to managing how you trade in and out of these spreads effectively.
Correct me if I'm wrong, when you're talking about position management or potential adjustments, even though we're talking about 4 different options per strategy, not every leg may require management at the same time, right? Meaning, for example, with an iron condor, it would only be likely that the call spread side or the put spread side would be tested at a time, but never both at the same time. Isn't that right?
Yeah, and that's one thing that's really interesting about this is that because of the way options work, the call side of this spread and the put side of this spread can't theoretically be in the money at the same time.
Right.
Because the call side of it is, on one side of the price distribution, and the put side is on the other side of the price distribution, and there's only one price at one particular time. So if you're trading a stock and it's trading 50, the 40 put and the 60 call cannot both be in the money at the same time. At one point in time, the 60 call might be in the money, but when the 60 call is in the money, the 40 put certainly isn't. And then the opposite is true also, right?
Okay. Yeah, excellent. Now let's shift gears for a second. Let's discuss the risks and potential benefits associated with these multi-legged spreads. What might traders be thinking about when looking at these two strategies?
Yeah, that's a good question, and I think a good way to kind of segue into this part of the discussion. Like any trading strategy, condors and butterflies have their own set of risks and benefits. One of the primary risks is the potential for losses if the underlying asset breaks outside of whatever potential price range that you have in your mind as far as what you decided to, and when you made the decision to put the trade on. Traders should carefully consider their risk tolerance and adjust their positions accordingly. One thing that's interesting about condors and butterflies specifically is that depending on whether you buy or sell them, and you and I have had this conversation many times, you can actually have a trade that works if that will increase in value theoretically if the underlying doesn't move very much over time.
Right.
And if you have that trade on, if you put that trade on for that reason, you need to be really cognizant of what you are theoretically planning to do if that underlying breaks out of that range that you're talking about. And that's the specific circumstance in which we're really talking about. So now on the flip side, the benefit of these spreads is that they're limited risk and they have defined reward potential. They can be really attractive strategies in range bound or low volatility markets. They offer opportunities to generate income in those circumstances. So traders can also, benefit really from those forces of time decay that we talked about before, working in the favor for these positions if the stars are to align in the way that people have forecasted them to, particularly if the underlying asset remains within the expected price range.
Right. And when we talk about the expected price range, we talk about generating income. We're looking at these strategies from the seller's perspective. Right. From the buyer's perspective, obviously, everything would be the opposite.
Yeah.
Okay. Excellent. Very important points. Matt, as we wrap up, what final comments would you have for our listeners who might be interested in exploring condors and butterflies? What's something that maybe they should look out for?
Yeah, that I think is a really good question. And it's something that in some cases, the answer to that question is kind of always the same.
Right.
But specifically with these spreads, I think it's important that people understand what I said before. They're complex option strategies, and complex means lots of different things to lots of different people, right?
Right. But it also means that because there's all of these different moving parts, these are generally considered intermediate or maybe even advanced strategies, not for the novice options trader.
Yeah, I would agree with that, and I think that I don't want to like scare people off from them because they're not. The actual optionality of the options exists in the same exact way that it does if you just have one call on versus a stock position, right? The optionality is the same. The thing that you're changing when you're creating complex option strategies is that what I said before holds true. Some of these positions, you are buying some options and then selling some other options against them. And so you just have to have your finger on the pulse of how you expect those options to move when implied vols move or when the underlying moves, and understand really the basics of how their Greeks can help you to forecast how those things might move based on how you've set up your option model. So it becomes even more vital to things like risk management and to things like, rolling in and out of position, that you understand a lot of the basics of how the options work, and that you understand the basic concepts of optionality, meaning the Greeks like delta, gamma, theta, and vega, and how those move option prices around when things like underlyings move or when things like implied volatilities move. Because if you have these positions on these complex strategies, you're going to have some of them that you're going to be long and some of them that you're going to be short. And those two options don't always necessarily move at exactly the same rate when the underlying moves. So it's important that you understand the basics of the optionality that exists under it.
And a lot of that understanding of the optionality can be found on our OIC website and various content that we offer. Certainly can be understood by reaching out to our investor services team with any questions at options@theocc.com. So OIC has some great resources in place to help investors understand the optionality that you're talking about and the potential risks and rewards of these complex strategies.
Yeah, absolutely. And it's important that we also always note that we're not registered investment advisors. So we can't direct you on trades. We can't suggest trades to you. But what we can do and what we really love to do is help you to understand the basics of how these options work and understand that optionality that underlies all of those options. And that's really at the heart of what all of our educational content is really just helping you to understand how the options work in a general sense, and then allowing you to use that knowledge base to expand your ability to actually effectively trade options for whatever your risk tolerance is.
Right. Excellent. And what you just mentioned is really the reason that OIC exists, and it's the reason that we have the jobs that we do. We're very, very fortunate doing what we are. Wise words, Matt. Thank you for joining us today and sharing your expertise on option condors and butterflies. But before I let you go, I want to do a lightning round, okay, and get to know Mat Cashman a little bit better.
All right, I like it. Let's have it.
So here we go. These are going to be either or questions, what you prefer. You prefer A or you prefer B. And since we're in Chicago, let's make this Chicago-centric for today. So let's start with Sears Tower or Willis Tower?
I'm going to have to say the Sears Tower just because I've spent most of my trading career within 2 blocks of it.
Okay, excellent. Deep dish pizza or thin crust?
Wow. Can I answer? I'm going to have to give the answer that resonates most deeply with me, which is I used to love deep dish pizza and I can't eat it anymore. So now I've transitioned into thin crust.
Okay, excellent. And that is the correct answer, by the way.
All right.
Let's see what's next. Cubs versus Sox.
Oh, that one's easy. I'm a North Sider, so Cubs.
Okay. This is going to be a hard one. Walter Payton or Michael Jordan?
Sports. I gotta say sweetness. I gotta go with Payton.
Interesting. Okay. And then last one, Green Bay Packers. Hate them or hate them?
I'll leave that one to you.
All right. Excellent. Mat, thank you so much for joining us today. And thank you to our listeners and supporters out there. Be sure to register and tune in to Mat's 2 upcoming OIC webinar events in July, the first of which will be discussing long condors and flies. So from a buyer's point of view, that's going to happen on July 12th. And then the following week on the 19th, Mat is going to be taking the opposite side and talking about selling condors and butterflies. Listeners, you can register for Mat's upcoming webinars via the events section of our OIC website, which is www.optionseducation.org. And as always, please feel free to send us your questions via email at options@theocc.com or live chat with us on our website. Thanks again to all those listening. Mat, thank you for joining us, and we'll be talking with you all again very soon. Take care, everyone.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you've heard on today's show, email options@theocc.com or visit www.optionseducation.org and chat with OIC's Investor Education team. Interested in connecting with OIC on social media? Subscribe to the OIC YouTube channel, like them on Facebook, follow them on Twitter at options.edu, and follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.